Should you invest in gold? Gold is a one-of-a-kind asset. It's very liquid but also being scarce. It's a luxury item as well as an investment. No one is liable for gold, and there is no counterparty risk. As a result, it can be an important part of an investment portfolio. In times of market stress, gold functions as a diversifier and a vehicle to reduce losses. It can protect you from inflation and currency risk, but should you invest in gold? Let's get into the video. Gold is prized all around the world as a high value and long history of being woven into cultures for thousands of years. Coins containing gold initially appear approximately 650 BC, and the first pure gold coins were minted about 100 years later, during the reign of King Cyrus of Lydia. People have kept gold for a variety of reasons throughout the years. Gold's worth has been perpetuated by societies and now economies placing a value on it. It's the metal we fall back on when other kinds of currency fail. Therefore, it's always worth something as a hedge against bad times. Here are 8 compelling reasons to consider purchasing gold today. Investors should be aware of the following facts. Gold is a widely held asset that is influenced by a variety of variables other than investment demand. One of the most effective diversifiers is gold when compared to other major financial assets. Gold offers competitive returns. Gold also provides downside protection, as well as a favorable return. Fiat currencies such as the US dollar tend to lose value against gold over time. Because of these variables, including gold into a portfolio can improve risk-adjusted returns. But how much gold should investors put in to get most bang for their buck? According to portfolio allocation research based on the pioneering work of Richard and Robert Machad, investors who hold gold between 2% and 10% of their portfolio can greatly increase their performance. This is true even if a cautious yearly gold return of 2% to 4% is assumed, significantly below its actual long-term historical performance. Buying gold is not the same as buying equities or bonds. You can acquire gold coins or gold bullion to take physical ownership of it. Bullion is gold shape of a bar with a stamp. The purity level at this amount of gold is the bar are stamped on the stamp. The value of bullion or coins is determined by their precious metal content rather than the rarity or condition, and it fluctuates throughout the day. Some banks, dealers, brokerage firms, and United States Mint, which has been producing gold coins in billions for investment since 1986, sell bullions and coins. Stock and gold mining firms, gold future contracts, gold-focused exchange trade funds, ETFs, and other traditional financial instruments are also available. When investors buy a gold block ETF, they are buying shares in a trust that owns gold, but they have no claim to the actual gold, a proven track record of retaining its value. Unlike paper money, coins, and other assets, gold has retained its worth over time. Gold has seen a way for people to carry on the project their wealth from generation to generation. People have admired the precious metal's remarkable characteristics since antiquity. Gold is easy to work with an imprint as a coin because it does not corrode and it can be melted over a regular flame. Furthermore, unlike other elements, gold has a distinct and lovely color. Because gold atoms are heavier and electrons move quicker, some light is absorbed, a process that requires Einstein's theory of relativity to understand. The US dollar weakens. Despite the fact that the US dollar is one of the world's most important reserve currencies, the dollar's value declines against other currencies, as it did between 1998 and 2008. Individuals typically turn to gold for security, driving up gold prices between 1998 and 2008. The price of gold roughly tripled, reaching $1,000 per ounce in early 2008, and nearly doubled between 2008 and 2012, reaching beyond $2,000 per ounce. The dollar fell to a variety of factors, including the country's massive budget and trade deficits, as well as large increase in the money supply. Hedge against inflation. Because a gold's price tends to rise with the cost of living rises, it has historically been a good inflation hedge. During high inflation years during the last 50 years, gold price has soared and the stock market has plummeted. Because gold is valued in those currency units, when fiat currency loses its purchasing power due to inflation, it tends to climb in tandem with everything else. Furthermore, because gold is seen as an excellent store of value, people may be enticed to purchase it if they perceive their local currency is losing value. Deflationary defense. Deflation is characterized as a period in which prices fall. Corporate activity slows and the economy is burdened by excessive debt. Sometimes hasn't happened since the Great Depression of the 1930s, although a small degree of deflation occurred following the 2008 financial crisis in some parts of the world. During the Great Depression, gold's relative purchasing power increased, with other prices plummeted. This is because people preferred to hoard cash, and at the time, the safest way to keep it was in gold and gold coins. Uncertainty in geopolitics. Not just in times of financial uncertainty, but also in times of geopolitical instability, gold retains its value. It's known as a crisis commodity because what global tensions mount, People flock to its relative safety. During these periods, it's often outperformed other investments. Gold prices, for example, have seen significant price changes this year as a result of European Union issues. Its value rises the most when people have less faith in governments. Supply limitations. Since the 1990s, gold bullion sold from more vaults of global central banks has accounted for a large portion of this market supply. Global central bank selling slowed dramatically in 2008. Simultaneously, new gold productions from the mines has been dropped since 2000. Annual gold mining output declined from 2,573 metric tons in 2000 to 2,444 metric tons in 2007. According to bullionvault.com, however, according to the U.S. Geological Survey, gold saw a rebound in production, with output hitting nearly 2,700 metric tons in 2011. A new mine can take anything from 5 to 10 years to get up and running. In general, while the supply of gold is reduced, the price of gold rises. Demand is growing. Increasing a fluctuation in developed market nations drove gold demand in prior years. Gold is deeply ingrained in the cultures of many of these countries. The demand of gold has remained steady in China, where gold bars constitute a traditional means of saving. India is the world's second largest gold consumer, and it is used for a variety of purposes, including jewelry. As a result, the Indian wedding season, the October, is generally a time of year when global demand for gold is highest. Gold has almost become popular among investors. Commodities, particularly gold, are increasingly being viewed as an investment class to which capital should be committed. In reality, as of 2009, SPDR Gold Trust was one of the largest ETFs in the United States and the world's largest holder of gold bullion. Diversification of your portfolio. Finding investments that are not strongly associated with one another is the key to diversification. Historically, gold has a negative correlation to equities and other financial instruments. This is supported by recent history. In the 1970s, we were a good time for gold, but a bad one for equities. Stocks had a great run in 1980s and 1990s, but gold had a bad run. Consumers shifted to gold in 2008, causing stock prices to plummet. To lower overall volatility and risk, properly diversified investors combine gold with stocks and bonds in a portfolio. Because gold's prices rises in response to circumstances that cause the value of paper investments, such as stocks and bonds, to fall, it should be a key component of a well-diversified investment portfolio. Although the price of gold fluctuates in the shorter term, it has always held its worth in the long run. It has worked as a buffer against inflation and the depreciation of major currencies over the years, making it a worthwhile investment. Investing in gold, whether real gold or gold-related instruments, is a difficult decision that should not be taken lightly. If you decide to acquire actual gold, make sure you deal with a reputable dealer. And if you acquire the gold for your retirement account, you'll need to work with a broker and a custodian. Financial experts recommend that you keep gold to a small percentage of your total asset as a general rule of thumb. This is thought to be sound counsel because it works as a safety net. If all your other equities go down in value in a crash, your gold should rise in value, preventing you from losing everything. However, keep in mind that nothing is guaranteed, so proceed with caution while purchasing this valuable metal. That is it for today. We'll see you in the next video.